Welcome back to Prosperity Pathways. I'm the OG, your guide to mastering personal finance and creating wealth. Today, we're diving into episode 7 of our series, where we'll explore the world of bonds and fixed income investments. We'll help you understand how these assets can provide stability and balance to your investment portfolio. So let's get started. Introduction to bonds. Bonds are debt securities issued by governments, corporations, and other entities to raise capital. When you invest in a bond, you're essentially lending money to the issuer in exchange for regular interest payments and the return of your principal at the bond's maturity date. Here are some key terms to understand. 1. Face value, the amount paid to the bondholder at maturity, also known as the principal. 2. Coupon rate, the annual interest rate paid on the bond, expressed as a percentage of the face value. 3. Maturity date, the date when the bond issuer must repay the principal to the bondholder. 4. Yield, the effective annual rate of return earned on a bond investment. Types of bonds. There are various types of bonds to choose from, including 1. Government bonds, issued by national governments. These bonds are generally considered low-risk investments. 1. Examples include U.S. Treasury bonds, UK gilts, and German bunds. 2. Municipal bonds, issued by state, provincial, or local governments. These bonds may offer tax advantages for investors in certain jurisdictions. 3. Corporate bonds, issued by companies to fund operations or capital projects. These bonds typically offer higher yields but come with higher risk compared to government bonds. 4. Agency bonds, issued by government-sponsored enterprises, such as Fannie Mae or Freddie Mac. These bonds are considered slightly riskier than government bonds but typically offer higher yields. Benefits and risks of bond investing. Investing in bonds offers several benefits, such as 1. Regular income. Bonds typically pay interest at regular intervals, providing a steady stream of income for investors. 2. Diversification. Including bonds in your portfolio can help spread risk and provide stability during periods of stock market volatility. 3. Capital preservation. Bonds are generally considered lower risk investments compared to stocks, making them an attractive option for conservative investors or those nearing retirement. However, bond investing also carries certain risks, including interest rate risk, the risk that rising interest rates will cause bond prices to fall, resulting in capital losses for investors. Credit risk, the risk that the bond issuer will default on its interest or principal payments, leading to losses for bondholders. Inflation risk, the risk that inflation will erode the purchasing power of your bond investment over time. Fixed income alternatives. In addition to bonds, there are other fixed income investment options, such as certificates of deposit, CDs, time deposits offered by banks, which pay a fixed interest rate over a specified term. Money market funds, mutual funds that invest in short-term debt securities, such as treasury bills and commercial paper, offering liquidity and low risk. Preferred stocks, a hybrid investment that combines features of stocks and bonds, typically paying regular dividends and offering a higher claim on a company's assets than common stockholders. Fixed annuities, insurance contracts that provide a guaranteed stream of income, either immediately or at a future date, in exchange for an upfront premium. Building a balanced fixed income portfolio. To build a balanced fixed income portfolio, consider the following strategies. Diversification. Spread your investments across various types of bonds and fixed income securities to minimize risk and optimize returns. Duration management. Balance your portfolio's sensitivity to interest rate fluctuations by investing in a mix of short-term, intermediate-term, and long-term bonds. Credit quality. Evaluate the creditworthiness of bond issuers using credit ratings from agencies like Moody's, Standard & Poor's, and Fitch Ratings. Laddering. Create a bond ladder by purchasing bonds with staggered maturity dates, which can help reduce interest rate risk and provide regular liquidity. Investing in bonds via funds. For many investors, the most convenient way to invest in bonds is through mutual funds or exchange-traded funds, ETFs. These funds offer several advantages, such as professional management. Fund managers select and manage the bond investments, allowing you to focus on other aspects of your financial life. Diversification. Bond funds typically invest in a broad range of securities, helping to spread risk and enhance returns. Liquidity. Bond funds can be easily bought and sold on the open market, providing daily liquidity for investors. Lower investment minimums. Bond funds often have lower initial investment requirements compared to individual bonds, making them more accessible for smaller investors. And there you have it. You're now well versed in the world of bonds and fixed income investments. By incorporating these assets into your investment portfolio, you can balance risk and reward, generate steady income, and enjoy greater financial stability. Thanks for joining us on Prosperity Pathways. If you found this episode helpful, be sure to hit the like button and subscribe to our channel for more valuable content on personal finance and wealth creation. In episode 8, we'll explore real estate investing and reveal how you can leverage property to generate wealth. So stay tuned. Until then, happy investing, and see you soon on the path to financial mastery.